Ken, thanks for the invite today. I met an old friend I haven't seen in years and years this morning, and I said to her, wow, you're really well preserved. And she said, John, you are too. And she said, except for all that white hair. Didn't have any white hair 2.5 years ago. Why do you think that would be?
Same.
So I represent the semiconductor industry. I run the Semiconductor Industry Association. It's headquartered here in Washington. We represent about 95% of the U.S. industry. We also have some foreign players in our membership as well. So the tariffs, Section 301, have had a lot of relevance for us. Just want to level set with a few things. First of all, pretty much all of our products were captured in the second list, semiconductors. Remember semiconductors, these little chips, these little magic chips that power everything that's electronic in your computer and your cell phones, IoT, artificial intelligence, quantum computing, that's all powered by semiconductors, and the advances we have in those technologies is all built on innovation in the semiconductor industry. So List 2 captured all of our stuff. List 1 captured a little bit, but where we really get hit is our customers. Our chips go into everything electronic, and List 3 started to get hit. Our stuff started to get hit, but if we get List 4, where we capture everything else, $325 billion is not captured so far, then that would really begin to have a very, very major impact on us. So, like my daughter said when she was in high school, often I'm so misunderstood. Our industry is a little bit misunderstood. First of all, how many people out there know how we rank in terms of our exports as semiconductors? What's is it 10, 20? No. Sorry, you're not a crowd pleaser. So we're number 4. So it's airplanes, refined oil, crude oil, semiconductors, and we just jumped ahead of automobiles. So while most of the electronics industry in the U.S. moved off of our shores decades ago, semiconductors have largely stayed here. About half of our manufacturing capacity is still in the good old U.S. of A. We produce in 19 states across America. In fact, there is not that much production that happens in Silicon Valley anymore. Florida, Colorado, Maine, who would have thought? There's these super exotic fabs that create semiconductors that now have up to 30 billion transistors on a chip that size. So another fact is we've run trade surpluses for the past 20 years, and with China, we run a healthy trade surplus with China. We are one of the most research-intensive industries in the world. We're right up there at the top slot with pharmaceuticals. So when it comes to supply chains in China, unlike a lot of other folks that have deep supply chains in China, we have a much more light touch. We're not as deeply ingrained in the Chinese economy as many other electronics industries are. As I said, roughly half of our production is here. Very modest production in China. It costs $5 to $15 billion to build a fab, about 5 years of planning, and most of that stuff is done not in China. Where our exposure to China is huge is because our customers are in China, and that's where all the manufacturing happens. So there's a lot of exposure vis-a-vis our customers. In terms of our big problems with China, it's not really market access. We make the most innovative chips in the world. We are by far the biggest chip producer in the world. We control about half of the global market. China is 35% of our market. It's our biggest and fastest growing market. So our problems, so the Chinese need to buy our chips. We have the most innovative chips. There's analog chips, memory chips, and there's logic chips, the brains, the processors. So our big problems are not so much market access. Our big problems are what the 301 is trying to go after. It's the IP theft. It's the trade secrets. It's the trade secrets. It's the forced tech transfer. And for us, a massive problem are the massive subsidies that the Chinese government has been throwing at its domestic industry to build an indigenous semiconductor industry. So I just wanted to level set with you all and have discussion about some details around here. And so try to close the delta and make our industry a little bit more understood.
Thanks. Like John, I'd like to thank Steve for moderating, for Wita and for Ken for inviting us. A conversation about China is always timely. I wanted to make just a couple of points to also tee things up. One is going to be related to kind of the composition of the China price. Second is going to be the dynamic nature of value chains. Third is going to be what are the macro impacts we've seen so far, and if I can remember it, I might pull a Rick Perry here, but if I can remember the fourth, it's going to be kind of just like some anecdotal evidence of what we've seen and what we may yet see. So the tariffs are obviously a cost. The China price and some of the reasons for the incredible imbalance that we've seen. John has pointed out some of the policy issues, which I completely agree with. In addition to that, there are other government policies that have contributed to this. Some of it's related to the currency and a long tradition of currency misalignment and manipulation. And it's also fair to say that over the last 2 years, whether you believe it's market-based or government intervention, the yuan has certainly devalued somewhat, which has offset some of these tariff impacts. That's one of the reasons why, and I'm fast-forwarding to the macro impacts, you haven't seen a kind of a shocking impact in terms of import prices coming into the United States. It just hasn't happened, and there may be a muted effect as well. So the other characteristics of the China price are obviously favorable tax policies, the subsidies that John had mentioned, the tech transfer. You also obviously have lower labor costs. You have lax enforcement of what labor laws do exist. There's no right to form independent unions in China. There is a poor enforcement record with respect to environmental regulation. And so when you add a lot of this up, it's hard for U.S. manufacturing to compete on a head-to-head basis in a lot of categories. I agree the semiconductors are an outlier there. And so that's why over the last couple of decades you've seen a lot of shifts of production from the U.S. to China for many different types of manufactured goods. It is also true that we export some high-value products to China. I think both could be true. But the nature of the China price is composed of a lot of different things. And these talks, however successful they are only going to address a few of those. The labor question will still be out there. The environmental question will still be out there. The currency question will still be out there. So what I guess I'm saying is that don't for a second think that we've solved all our challenges if there's a successful conclusion to these talks within the next month or two. The other thing that I would say, and I'll shift to value chains here, is that clearly the tariffs are disruptive. They're designed to be. The tariffs are designed to change or produce considerations of changes in behavior for both consumers and producers. I mean, that's part of the theory. But But underlaying all of this is the fact that value chains have always been dynamic. And they looked a lot different in the 1980s and the 1990s and the aughts than they do today. And they will continue to evolve as well. They're evolving within China, from coastal to inland to other low-cost centers. And so the tariffs may accelerate some changes that were already underway, but there were a number of multinational companies who had begun to reevaluate value chains prior to the last 2 years. We saw a substantial amount of evidence of that post-recession, as particularly in manufacturing, as the cost composition of manufacturing has changed, and it's become a little less labor-intensive, a little more automated, where energy costs are a higher driver, and where a lot of the shifts of production to China had unintended consequences as well. Inventory control, quality control, a lot of the other issues that were hard to manage and ocean away. But value chains are dynamic. They will continue to be with or without these tariffs. These tariffs may be an accelerator, but they certainly aren't the only driver with respect to the value chains. The macro performance. So far, I mean, Trump said, tariffs or trade wars are easy to win. Well, I disagree with that completely. That's an oversimplification. But it is also true that we have we're operating from a macro level from a position of extraordinary strength. We have a strong economy. We have incredibly low unemployment, low inflation. We hold the reserve currency. And so there are a lot of good indicators. We're well into an expansion. The stock market has certainly been volatile, but it hasn't collapsed in any systemic way. And so the president is quite fortunate because he's got a lot of macro tailwinds here. That isn't to say that there may be problems on the horizon or it may be like that forever. I don't know how long that will last. If I did, I'd be in another forecasting business. But at least for now, there's a position of strength. And as I said, import prices from a macro level, not particularly inflationary. Trade deficit with China, which I think is one measure that the president watches closely, was a record high last year, but over the last few months has come down pretty considerably. Whether this is a trend or not, we'll see. There may have been some forward loading, so we'll see what happens there. In manufacturing in particular, unemployment is unbelievably low. It's 3%. There are 476,000 open manufacturing jobs right now. And the balance sheets of a lot of manufacturing companies look relatively healthy. There are some exceptions to that, and I think you see signs of plateauing in the auto sector and a few others. So again, I don't know how long the macro position is going to stay a great one, but for now, that's obviously something that the president has that he can use to his advantage. And finally, just some anecdotes here. So just within the last few months, you have seen firms react to this in a certain way. Stanley Works bought Craftsman Tools, is shifting production of a lot of those tools to the United States, is opening a new factory in 2020. Nucor is building a greenfield plate mill, steel plate mill in the United States. If you had asked anyone over the last 30 years if that would ever happen again, the answer would have been a resounding no, but it in fact has happened. When you look at surveys of C-suite folks who do procurement and who do sourcing, many more of them are looking at shifting production out of China, some to the United States, some to other locations as well. So it's certainly, that pace is certainly accelerating somewhat. Now, will this be a successful enterprise? That's the question. I don't know. I kind of agree with Aaron here, that there's a lot of uncertainty and that there's exactly one decision maker in the United States, and ultimately the decision he may make is like, how am I doing in Pennsylvania, Ohio, Michigan, and Wisconsin? Above all else, who am I to say? So I certainly don't have any insights into his mind, and I would argue none of us in this room do as well. So we, in a way, are kind of, I think, held hostage to that, and that's an incredibly uncomfortable position to be in, which I think is why we have a lot of these fora to talk about.
Thank you.
So it's like counseling. Thank you for paying for my WIDA membership for counseling. Perfect. Hi folks, my name is Hun Kwike. This is my WIDA debut, so thank you very much to Steve Lamar and to for the opportunity to come speak to you all today. I think that the best title other than Vice President for International Trade for myself is personal shopper. I loved in my past life to go around and tell people when things were on sale, when there was a good deal to be had, and now I feel like I'm that shopper who's like, oh, that's tariffed. That's being tariffed. This sweater, this jacket, it's being tariffed. So I think my friends are really tired of me talking about work. But to just do something different than what the panelists up here have already done, I wanted to give you a sense for what the retail industry has been doing over the last year. I think that for us, we have been leading the charge when it comes to the U.S.-China trade war and trying to tell the story about the impact of the administration's decisions. And for us, the tariff story really started all the way back into the beginning of 2018. When you think about washing machines, yes, we sell a lot of washing machines. We also were impacted by the steel and aluminum tariffs. If you think about our store shelves, our warehouses, our distribution centers, those are all made with steel and aluminum products. We are not the importer of record, but of course, when those prices increase, those are trickled down to us. And then for us, then the 301 threat came to be. And so in March of 2018, we worked with some of our key trade association allies in drafting a letter to the president, signed by 25 of America's top retailers and brands, asking for the administration to spare consumers and American families that would bear the brunt of these tariffs. And for the large part, I think that the administration heard us. We saw in Tranche 4 the delay of tariffs on products like clothing, footwear, consumer electronics, and toys, which, by the way, has a zero tariff. So again, personal shopper, you're welcome. But I think that when you're thinking about the various tranches of tariffs and the mitigation strategies that our companies have pursued, it is a very different scenario when you're talking about a 10% to a 25% tariff rate. I think when you saw tranches 1 and 2, we were very successful in getting several of our products off that tariff list. So for example, in tranche 1, you noticed that TVs were originally on and then they were off. And I think that is a result of our direct engagement with the administration and telling the story about our supply chain. So when you're thinking about where you buy your TVs, explaining to the administration that in fact the TVs coming from China are the middle-class American family-sized TVs that you have in an average living room, and the ones coming in from Mexico, which are not in fact substitutable, are your Jumbotrons and your Super Bowl type TVs. And so, those are that price range and that affordability is very different for our American families, our customers that we serve every day. So I think that thus far we've been successful. I would also I'll save for later the product exclusion secrets of our success. I'll save that for later. But when we think about the 42 million jobs in the retail supply chain, we talk about the jobs from shore to shelf, that there are a lot of folks who touch our products to make sure that we get the products onto our store shelves in a timely manner. And I think that if anything, it has pushed that chaos on sourcing all the way to the manufacturers, whether they're in China and now the EU with the EU 301 tariffs or the steel and aluminum tariffs with respect to some of our other trading partners. I think that has triggered a harder look at our sourcing challenges. I think that for some of our sourcing executives, though, they look at me and they say, well, it's if I move, it's damned if you do, damned if you don't. So we don't know how long these tariffs are going to be in place. I think that is that level of uncertainty exacerbated by the volume of product that we bring in every day, whether from China or from another country. I think that tariff or just the supply chain uncertainty has really impacted our ability to effectively carry out our daily work, much less the mitigation strategies that our folks have been pursuing. And then, with Tranche 4, we now have products like clothing, American basics that we get ready every morning, put some clothes on, hopefully all of you. Yes, thank you for wearing clothes today. For all of you, we put on clothes, we put on shoes, we grab our backpacks. These are all products now on the president's tariff list. And so backpacks are already on. I guess you would make sure that I say that. Tariffs are already on backpacks. But what we know from the Global Value Chain Coalition did a study is that over 70% of the value of a pair of pants is made here in the USA. That is designed, those are fabric engineers, those are web developers, those are folks who are supporting our e-commerce business. So I think that there is a lot of value when you're thinking about a particular product. It may say made in China, but in fact, a lot of that support to bring that product here to the United States and to your home are supported by U.S. global value chains and U.S. jobs here. The last thing I'll say is that for us, our recommendations to you all on how to engage on the 301 process are, one, to engage. I think that we have seen results come through by coming in and submitting written comments to testifying at the public hearings, and I have no doubt that many of you in the audience will be testifying at the hearings coming up in June. The last hearings we had over 350 witnesses that took over 6 days. So we're anticipating about 2 weeks worth of hearing to be taking place at the ITC. And then also make sure that your story is being told. I don't think that anyone else knows your supply chain better than you do and your sourcing executives. And I think it's really important to educate not only the administration, but also the public about the U.S. jobs that are dependent upon those products coming in. And then finally, I would be remiss if I didn't also suggest to you all to join the Americans for Free Trade Coalition. It's a coalition that is working to tell the story about the tariffs. I think that we've got our tariff tracker online right now, and it's close to about it's over $25.5 billion that the administration has already collected in additional tariffs. It's about $1,100 per second. I'd like to be making $1,100 per second, but I do not. I could buy a lot more things if I could. But the big question is, are tariffs the means to an end, or are tariffs the end result that the administration is seeking? I think that is the hard question to be asking, because at this point, if the goal that Ambassador Lighthizer had said to the Ways and Means Committee last year was to bring maximum pain on China, minimum pain on U.S. consumers, we are getting there. And we are probably there as of June 1 with the tariff increase to 25%, that our member companies can mitigate as much as we can to spare American consumers from the tariff burden. But I will tell you that talking to some of our executives, they're thinking about various strategies. So instead of a higher quality item, you get a lower quality item. Instead of a box of stickers that you get that includes 100, maybe you only get 80. And it's really difficult for the American consumer to really feel that or to understand that. But I think those are the kinds of things that you might start seeing on our store shelves moving forward. But our margins are so razor thin that there's no other place for the prices to go other than to increasing consumer prices. So why don't I just stop there and just